We are going to wrap up, though, with a result from this morning as we record, which is Whitbread. And it's fair to say it wasn't taken that well by the market. That said, Erin, figures themselves, in terms of what has happened, as opposed to the outlook, which we'll get to in a minute, weren't too bad, slightly ahead of expectations in some ways.
Yeah, it's true. I think the figures could have been a lot worse. There certainly was a drop in revenue and profit, but given the softer market environment, I don't think that was a huge surprise. The main headline, I think, was the drag that the food and beverage unit kind of pulled down on the revenues because of Whitbread's new plan to convert a lot of their low returning restaurants into rooms. I think the CEO called it the restaurant to room scheme. Um, but yeah, certainly could have been a worse set of results.
And we look at the shares, the reason they're down in part is because of what it's saying about the future. There's a few things here, isn't there? There's more costs in the UK. There's a slight lowering of the estimates for Germany, I think, for, was it the full year or for next year? But a little bit there, and lease costs perhaps as well. Can we talk about maybe the first two to start off with? Because the UK and Germany are Whitbread's two big markets. They are the focus of its expansion plans, as you'd expect. But there are some issues there right now, partly to do with this soft market, but also increased costs, as we say.
Yeah, you're right, Dan. So I think a big part of the reason why the shares slumped is to do with the environment in the UK and the level of cost inflation that we're seeing, and Whitbread's response to that, which has been to accelerate their cost efficiency program and boost their targets. So they did want to save 60 million in cost by the end of this year. That's now gone up to 65, 75 million, just reflecting higher wage prices, utility bills, that kind of thing. And I think that definitely hit sentiment. And then the second piece of your point around Germany, that was also a difficult one for investors to swallow because I think a lot had been said about Germany forming quite an important part of their growth and expansion plan. And this morning they actually did revise down their profit guidance for Germany. So originally it had been guided to be about 5 to 10 million, that range, and now it's up to 5 million. So I think that was certainly a negative for the market's reception of the
Mm.
results.
Yeah, this is having now checked. This is the full year guidance, isn't it? Full year financial 2026 with another 6 months to go. Because I mean, there was some better news on Germany, wasn't there? Insofar as they said the second quarter, the quarter we've just had, was a bit softer, but things have been picking up in recent weeks. Albeit, you do tend to hear people say that when it comes to results. So maybe they are gradually working through this, but nonetheless, they've had to reflect that soft quarter in the full year guidance. Can we talk about the UK, the soft market we've spoken about a couple of times already? What exactly that means for Whitbread and what it means in terms of expansion, because it does have this big plan, which we'll get to. It is taking market share in a market that's struggling, which is a good thing, but nonetheless, the underlying factor is that the market is slowing down slightly.
Yeah, it's true. And I think the consumer confidence being a little bit shaky to a certain extent does play into Whitbread's hands, given its Premier Inn hotels are fundamentally a budget hotel brand and consumers are still choosing cheaper breaks if they are choosing to go on breaks. The other side of it is that they have really strong brand awareness for Premier Inn. So that's definitely a kind of point in their favour, and Premier Inn has continued to take market share. But that said, you kind of can't ignore the broader macro, and things have been slowing down. I think after several years of outpacing their competitors, they kept UK accommodation sales flat for the half, which is good. It's better than kind of going backwards. But at the same time, when you look at their progress in previous years, it does show the kind of sentiment of the broader market, I think, in the UK.
And let's talk about this AGP, the Accelerating Growth Plan, which they have in place. It's out till 2030. It's a 5-year view, so we're still very early on. Can we just encapsulate what that involves? We've kind of touched on some of the points already, but what are they trying to do to drive growth in future?
Sure. So I guess it came about really after they sold the Costa Coffee kind of branch just before the pandemic, and that really meant that it had to pivot towards its hotel Premier Inn business. And as a result of that, it has a number of slightly lower returning restaurant brands, which are now going to be transitioned into a more integrated food and beverage format. And they're hoping to unlock around 3,500 new rooms as part of that. So there's an element of this that is going on in the UK, and also the German operation is expected to make a contribution to that accelerated growth plan. I think they're targeting pre-tax profits of 70 million by 2030. They want to get 20,000 rooms in Germany. And they are making progress there, as well as their UK room targets as well. But there's maybe a question to be asked around how many more rooms a quite soft market might need.
Mm. Yeah, the room expansion is a big thing. The issue with some of the restaurants wasn't that they were fundamentally lower returning. I mean, Whitbread makes a pretty good return on capital for the hotel side of the business, so it wants to focus more on that, understandably. Mike, I might bring you in here, as you've looked at Whitbread before. You've got some reservations, no pun intended, about the plan.
I will get to valuation soon, and I kept them on a buy, but I think peppered some more skepticism in last time we covered them, and part of that is the expansion plan. Markets have been soft, and of those 3,500 rooms, I think about a third are due to come on stream this year. So short term, at least, that looks quite a lot softer. The company's argument is that a lot of independents have gone bust since COVID, and overall room numbers are still below and aren't expected to reach pre-COVID levels until 2027. And they also will talk about a greater preference towards trusted brands like Premier Inn. But then I also think that there are quite a lot of other people going for this market, whether that's Travelodge, whether it's some of the European brands like Radisson or Accor and Ibis, or even Motel One, and even the likes of Weatherspoon and some of the pub chains. They're all competing for that budget market.
Yeah, it does seem Premier Inn, they're targeting both that side of the market, but also people, as you said, Erin, who might be looking to scale down slightly, and certainly business customers too. But I think when we last discussed Whitbread on the show, probably a couple of years ago, I mean, they do have, the branding is very good. And you think of something like Travelodge, the problem there for me is you never know what you're going to get with a Travelodge. With a Premier Inn, you can feel relatively comfortable that you are going to get a decent place.
I think that's a fair enough assessment, but if you look at Radisson, people are willing to give...
the bigger players coming down is probably a bigger issue.
Yeah, and Radisson are doing a self-service model, the Red model, which is cheaper, which I know Premier Inn are also have a kind of budget offer where you check yourself in and find your own room. Or there's limited service is what they call it, isn't it?
Mm. Yeah, that is an issue. There are people tugged in this market who have a better reputation themselves too. So
and the likes of an Ibis or a Motel One or some of the Dalata business, some of those like the Clayton, etc., are aimed at a similar market and quite often going for the airport hotels as well as the city ones.
Mm. Another thing in the figures that caught my eye a bit was the lease costs, which I think were probably less of an issue for investors than the UK, Germany issues we've outlined, but may have been an issue nonetheless, because Premier Whitbread is funding this expansion in part by selling off some of its estate. From memory, I think it's about half, just over half of its estate was freehold as opposed to leasehold. What it's doing to a degree now is selling some of these and leasing them back to raise some funds for the expansion, which means the capitals are all in-house. It means it can continue with its plan to provide buybacks and dividends, etc. But that does mean higher lease costs because it has more properties to lease, and it did flag those in these results, which might be something to watch in future.
Yeah, definitely. And I think that's certainly already coming through when you look at their net debt, including leases figures, and their leverage figure, which is creeping up a little bit now. I think it's 3.2 times, and their investment grade threshold is 3.5 times. So certainly something to watch, Dan. And you're right, the project to recycle capital is a big part of their 5-year plan. I think they want to recycle 1 billion of their property over the life of the plan. And while sale and leasebacks are definitely one way they can utilise quite an asset-backed balance sheet to support the future growth of the business, there is certainly kind of later down the line a consideration around how that might impact their net debt, leverage, covenant metrics, and how they're going to manage that. I think in the year to date, they've leased back 4 transactions with a net initial yield of 5.3%. So you can imagine if they kind of keep adding those up, then it will become a higher number.
Yeah, indeed. On the plus side, there is the value of their estate. Some people think hasn't really been recognised in the past as a backing for the business in general, and selling will release or at least justify some of that values. And they have announced a new property valuation range, I believe, in these figures, which outlines the value of the entire estate, which was a little bit higher than people thought, and there were maybe some concerns over the last few years since prior valuations that all the trends we've just been talking about property in general might have, and also higher interest rates might have affected those valuations. So the fact that that value is still pretty high shows there is value there, which maybe isn't being recognised, but then they are making use of that value, as we've said. So that's something to watch. Let's wrap up by talking about our stance in the company. Mike, I think you just said when you covered them last time around, you kept them on a buy, but this time we are lowering them to a hold. Is that effectively because of all the things we've just spoken about? It's a decent business, but there are question marks about the future.
Yeah, I think there's an element of circumspection there, just given the UK market and the fact that that does still predominate in their numbers. And also there's that thought around potential lease costs in the future, subdued guidance in Germany. It's not to say that they wouldn't go back to a buy, but for now, I think we're holding a little bit of caution on the name.
Just to see while they work through this plan, or the early years of this plan and this expansion, and how it pans out.